Hello guys and welcome to the Groww Academy. Now, did you just start your investing journey? Great. Congratulations because you have taken the first step. The journey from here is a long one, but we're here to make it super exciting for you. Now, on Groww Academy, we'll break down even the most complex topics about stocks and try to make it as simple and easy for you. So let's begin. Now, this video is all about building your foundation because everything else we'll talk about later will be based on these fundamental basic concepts. Now, the first thing is what are stocks and what are the benefits of owning a stock. Now, you might want to note that the term shares are often most used as instead of shares, it's also known as stocks in many places. Now, these two words mean the same thing, right? However, throughout this course, I will be talking with the term stocks instead of shares. Now, stocks, and let's look at the history of stocks. Now, before we begin, let me ask you a question, right? Can you guess which was the first company which was publicly traded in the stock market or in stocks? Let me give you a hint. It's known for being involved in the colonization of many countries, including ours. Another hint, it has India in its name. Yes, if you've guessed it right, we're talking about the East India Company, right? Now, how did East India Company become the first publicly traded stock, right? The answer is simple. Because of risk. Now, around 1600 AD, India and Southeast Asia were very popular for trading opportunities. They had spices, cotton, sugar, salt. Traders from all around the world wanted to benefit from this, and they sent ships and voyages to basically export these goods. But it was quite risky. Many times these ships would get lost and get seized by pirates on the way. So, the traders realized that it didn't make sense to put all eggs in one basket. That time, they would invest in one voyage or a company at that point, which meant that they could lose all their money at once if anything happened. They had to do something to lower their risk. And that is when the dilemma gave the birth to the East India Company. Now, they could buy stocks in multiple companies. So if one ship was lost, the trader could still make a profit from the other ship of the other two companies. The system here became very, very popular. In 1602, the Dutch East India Company officially released stocks on the Amsterdam Stock Exchange, which is also known as the oldest modern stock market. Any investor could buy stocks and bonds and get a percentage of the East India Company's profits through this. Interesting, right? Now, we talk about risk all the time in the stock market, and that turns out to be the sole reason behind the first company actually publicly trading in the stock market. Now, what the East India Company did beyond this, we all know it from our history books. But this story was just to talk about its connection to the origin of the stock market. Now, while East India Company was created for trades that were exported from India and Southeast Asia, stock trading in India started much later. In the mid of 1800s, 22 stockbrokers stood under a banyan tree opposite the town hall of Bombay and started trading. Now, more stockbrokers eventually joined in and they finally settled in Dalal Street in 1874 and organized themselves as the Bombay Stock Exchange. Now, obviously popularly known as BSE, it is one of the largest and the oldest stock exchanges in the world. Now, what are the stocks, right? Now, stocks are basically, if I put it in simple terms, one stock is one unit of ownership in a company. Now, when you buy a stock of a company, you become a shareholder. You basically own one stock of the company, and that means you benefit from the profits that the company makes or even the growth of the stock price in the market. Now, how does that happen? Let me give you a simple example. Now, suppose you bought 10 stocks of ITC at 200 rupees each. Right? Now, if ITC had a good year of profits, they may decide to distribute these profits as dividends to all shareholders like you. Now, if ITC continues to do well in the future, more investors would want to buy ITC stocks and the demand will increase. If the increase happens, their stock price will go from 200 to maybe 250 rupees. Now, at this point, your invested value increases by 50 rupees per stock, which is basically 500 rupees profit for the 10 stocks you bought. Now, you might ask, why do companies actually sell their stocks? The main reason is to raise money, which is also one of the reasons. They need the capital to maybe invest in a new project or they want to expand their business, right? This is a possibility. Now, a lot of people often get confused between stocks and equity. Now, what is equity? It is quite simple, honestly. Let's say a company has 100 stocks in total. You went and bought 10 stocks of that particular company. Now, let's say you own 10 stocks, right? Now, in terms of equity, you will say that you want 10 stocks of the 100 stocks that the entire company has, which means you want 10% of that company or 10% equity of that company. So equity is nothing but your total ownership stake in a particular company. Now let's look at the benefits of owning a stock. Now, a lot is said about the extremes of investing in stocks, either about someone earning a lot of money or maybe someone's losing a lot of money. But owning a stock means much more. And let's talk about that. So what are the benefits of owning a stock? Number one, dividends. Now this is a part of the profit that the company makes and then gives it to shareholders, which is you. Number two, capital gains. Now let's say you buy a stock of a company for 100 rupees. Now if the company is doing really well, more people want to buy their stocks, right? So the demand of this goes up, the demand increases and probably increases the stock price as well. Now at this point, you can sell the stock that you bought at a higher price and earn a return of your investment. Now that is known as capital gains. Number three is the claim on company assets. Now let's assume you invested in a company some time ago, right? Now due to some reason, the company is shutting down. What now? Right? First of all the assets of the company have to be liquidated. Then anyone who has lent money to the company gets paid. After that, you as a shareholder gets paid of what is left. Now you might have heard that equity or stocks are riskier than debt. This is why. Because creditors will always get paid before equity shareholders in these kind of scenarios, right? Now, the fourth advantage of owning a stock is voting rights. Now, every year, companies hold annual meetings to discuss important issues like management changes or electing a board of directors. Now, in this meeting, you get to hear about the overall performance, the future plans of the company, and all management decisions. Now, as a shareholder, you actually get to cast votes during the meeting. Now, fifth point of the benefits of owning a stock is no liability, right? So being a shareholder in a company gives you all the benefits without any liability. That means, for example, if the company declares profits, you get your dividends. But if the company goes bankrupt, you are not held responsible for the loss beyond the value of your own stocks that you hold. Finally, now, all the buying and selling of these stocks, where do they happen? And how does it happen, right? That we will discuss in the topic, and that is the next video as well.